Hi, everyone. Welcome to the Power Hungry Podcast. I'm Robert Bryce. On this podcast, we talk about energy, power, innovation, and politics. And I'm pleased to welcome Arjun Murti. He is a partner at Veriton and publisher of Superspiked on Substack. Arjun, welcome to the Power Hungry Podcast.
Robert, it's a pleasure to be here. Thank you for having me.
Now, I told you I don't warn every guest, but I warned you that the guests on this podcast introduce themselves. You had a long career, including investment banking at Goldman Sachs, but I'm not going to talk about that. You are. Imagine you've arrived somewhere, you don't know anyone. You have about a minute to tell the people at this dinner party who you are. Please tell us who you are.
Robert, I've spent just over 30 years. I identify as an equity research analyst. That was my career at Goldman Sachs, where I spent the bulk of my time. I started on a small boutique investment bank in Denver. I was on the buy side at JP Morgan, but 15 years at Goldman. Looked at really the sector from the lens of covering the major oils, independent producers, refiners. I did my time looking at, quote, clean energy. I'm not sure how clean it was. It, I guess, produced energy 20 years ago. Ran the research department, did a bunch of different things, was a partner at Goldman, and burnt out on the director of research jobs. I love being an analyst, hated being part of management. My wife convinced me to retire. I got to catch my kids in middle school and high school. They're now off to college. And during that time, I joined the board of ConocoPhillips. I'm a senior advisor at Warburg Pincus, and I'm affiliated with both Columbia's Center on Global Energy Policy as well as ClearPath. So some public policy perspectives from those two organizations. COVID hits. We have all this sort of insanity around energy transition. It motivated me to start a Substack in November of 2021, which in turn motivated me to, as I say, unretire and join Veriton, which is energy strategy, investing, and we say something else, but I'll just say shorthand, an energy consultancy focused on hopefully getting this energy transition to be less insane than I think it's currently on track to be.
Well, good. So I want to talk about that insanity because there's plenty of it. And on my Substack, I just published a piece called The Energy Transition Isn't. But before we go on, I've had your colleague, Brett Brampall from Veriton on the podcast. And we have a mutual friend there, of course, Maynard Holt and Michael Bradley and some other folks. You run a very interesting group based in Houston. Veriton is. It's Veriton.com. Is that right?
That is right.
On the internet. Right. And then Arjun writes Superspiked on Substack. So those are the places you can find him. Okay, so let's jump right into it because I'm looking at this article that was in the Wall Street Journal on Friday. The headline is Oil Sector Mulls a Slippery Future. Energy executives offer very different opinions on how much of the fuel the world will need by 2050. Last week, Enverus predicted $100 oil. Today, John Kemp on Reuters said portfolio investors are exceptionally bearish about crude. Okay, what the hell? Does anyone really, this is my first question, does anyone really understand what's going on in the oil market? Because we have two very different calls, very sophisticated analysts, one saying look out below, the other saying $100 oil by Q4. What the hell? What's going on?
Well, all of that in part is driven by what is this insanity of energy transition. So there's certainly a bunch of folks who think for whatever reason, crude oil demand and the crude oil markets are going to go away in some time frame. And I think you have any other view than that, then there's at least a hope and future for this business. I start by, my focus tends to be on the longer term cycles. That was what I tried to focus on at Goldman years ago and what I do in my Substack, which is these energy cycles. To simplify, especially for crude oil and natural gas, 10 to 15 years up, 10 to 15 years down. And of course, we're just coming off one of those 15-year down cycles from 06 to 2020, which helped people think you don't need crude oil, it can go away. And we're now on the other side of it, where my language I use is super vol as opposed to super cycle, and we can get into that. But I do think we're on track for a pretty volatile period. But through those ups and downs, I think profitability is going to be better for traditional energy companies, at least for a period of time here. And I actually think demand is still headed up for the foreseeable future. And I think we could have some debate on when it may end, but it's hard to pick the date when we have peak demand, when there's still so many billions of people lacking with all that we take for granted and as a given here in the US, or for those that matter, those folks in Europe.
Yeah. Well, let's talk about that, because that's the part that I've been looking at. I imagine I'm somewhat like you. We just now have introduced ourselves. I haven't talked with you before, but the statistical review of world energy just came out. Oil demand last year went up 3.1% globally. it went up about, if memory serves, in the U.S., it didn't go up that high, but natural gas consumption in the U.S. went up more than 5% in 1 year. That is a huge jump for a market as big as the U.S. But globally, demand last year, well, let me see, where were the numbers that, oh, never mind. But the U.S. demand was 20.5 million barrels a day in April. And then this is the other indicator. Buc-ee's just opened the world's largest gas station in Tennessee, 120 fuel pumps. I'm thinking, why do people think we're not going to need oil? That's the part that I look at these numbers. I look at the statistical review of world energy. I look at the fact we have, what, in the U.S., 280 million motor vehicles, nearly all of them run on oil. Why are people thinking we don't need it anymore? That's the part that I don't understand. From where does this come?
I mean, all energy, and I know you know this, Robert, is critically needed. So I tend to be agnostic. I don't believe in picking sides. I think it's a question of what is available, what is affordable, what is reliable, what is secure, and then ideally, can you meet those objectives with hopefully as small of a climate and environmental footprint as possible? But make no mistake, it has to be available first and foremost. We all know you can't go 5 seconds without energy, and you don't actually care what you pay for it. That's a secondary objective. You don't care what country or region it comes for. You don't care whether it's you frankly don't care whether it's an ICE vehicle or an EV or any other form of energy. You want to use energy as critical to everything we do. And I feel like that's often forgotten in this energy transition discussion, which is focused on one singular objective of net zero CO2. And we can debate the legitimacy of that objective, the timeframes. There's lots you can debate about it. To me, it starts with asking the wrong question, which is the world needs energy, and what is available and what is affordable. And that is why we use crude oil. So yes, I have driven a Tesla for 7 years. I actually love driving that car. I'm also a retired Goldman partner. I have the house where you have the charger at home. Not everyone has this sort of very fortunate situation. So the idea that this is going to be the be-all, end-all answer for all is what I push back on. And when you go through the math of all the people around the world, the amount of oil they're using, we use 14, 15 barrels per person, the lucky 1 billion of us who live in the US, Europe, Canada, Japan, or Australia. The other 7 billion people are using like 3 barrels per capita. Like, the numbers aren't a close call. And so how do you solve their needs? How do we stop being so egomaniacal about it and believing that our perspectives, or really the European perspective on how to solve energy, is the answer? How are you going to solve the energy needs for the other 7 billion people on Earth? And the idea that they're all going to be plugging in their Teslas in their home garages is simply a fantasy. And so it is basic economic growth, it is basic population growth that I think drives the demand for oil. And I think that continues for the foreseeable future, at least into the 2030s, but probably longer than that.
Right. Well, so that's the narrative. This is I have a lot of people on the podcast. I travel a lot. I'm very fortunate in my life. And I talk to a lot of people about, well, if I gave you $10,000, where would you put your money? Right. And I get varying answers, of course. Some guys are into crypto, some are into gold, some of the CDs. I don't trust anybody. I'm going to put it in the bank and earn that. Right. But when you look at the investment landscape, and this is something I've talked about with my brother, who's a CPA, he's an investor, and my friend Art Smith, who used to run John S. Herald, we're looking at the pricing on oil and gas stocks relative to particularly technology stocks. I mean, it's unbelievable how on a relative basis they're cheap. And I'm not former Goldman. You know more about this, is your world, not mine. But is that narrative of, oh, we won't need oil, is that the reason why we're seeing these hydrocarbon stocks selling at such a discount relative to other stocks in the marketplace?
I think there are two narratives out there. One is the idea that crude oil, and for that matter, natural gas, are going to go away at some point. Some people think it's as soon as this decade. And by going away, I mean peaking and starting kind of a permanent decline, if we consider that as, quote, going away. I think the other element is in 2022, profits went from losing billions of dollars at the height of COVID in 2020 to a 25-30% return on capital for the sector, which is a terrific number. The long-term average is 10%. They earn 30%. So people say, hey, peak profitability in 2022. And I have some concern, even if I'm not a climate ideologue. I don't know what I believe or not believe. This is the market out there. Maybe it might go away, but if I have peak profitability and there was this war thing, and who knows whether that disruption can last or not, I think this idea that the business is going away and it won't be profitable because it wasn't for the previous 15 years explains the discounted valuation. And that is the opportunity. If you think the business is not going away, which I don't, And if you think, at least for the top quartiles of companies, better profitability has a fighting chance, especially in a world where everyone's saying, don't spend money. Public investors or traditional investors saying, don't spend money because you guys wasted a bunch last decade. The climate folks are saying, don't spend any money because we think you guys should go away on, ethical grounds or whatever their arguments are. For all those reasons, you're getting a real lack of CapEx increases, and that supports ongoing profitability. And so that I think is the opportunity in this sector, the idea that profitability and the business can last longer than just the next few years.
Well, and that's the part that to me is interesting is that, ExxonMobil, what the PE is 7 and something like that, and the dividend is 3.5. Or Pioneer Natural Resources. I've interviewed the CEO who's just now leaving. I'm sorry, his name is
Scott Sheffield.
Yeah, Scott Sheffield. I had him on the podcast talking about this very thing. And he said, well, we're returning cash to shareholders, that we're being very disciplined in how we allocate capital. So I guess one of the things when you're saying this that pops into my head is, well, you have a natural decline rate in the oil and gas business of 6% a year, 7% a year. That's natural, right? Kind of globally, right?
Yep.
So if investment stays flat on capital, investment stays flat, you don't increase it, then that 6 or 7% decline rate, after a few years, you're going to have 20, 25% less production than you did 3 years earlier. If there's less supply, then prices should go up, right? I mean, am I missing something here? I'm not an economist, but that seems fairly obvious to me.
I mean, this to me is always the protection for those folks out there who do not have some detailed supply-demand model and are concerned that demand might go away. Again, I'm talking about non-ideologues here, just regular portfolio managers. It is much easier to stop CapEx, and then you get the 6 or 7 or even 8% declines that you were referencing, versus killing demand and displacing or removing or changing your ICE vehicles, your internal combustion engine vehicles, to electric vehicles or something else. And so even if you're pessimistic on demand, it is much more likely that CapEx will stop first because people are moving away from the sector, which we're starting to see, and that supply will be insufficient relative to whatever demand is. Never mind the scenario where I think demand does continue to grow 1%, maybe a little over 1% per year, based on population growth, the world's poor becoming less poor, the world's less poor becoming middle class, and so forth. That trend, which is a good trend, the world is better than it was 50 years ago, 100 years ago, because people are less poor, and they're less poor because they're able to use modern energy. And the idea that you'd want to stop that, the idea that that's somehow bad or evil, people, I think, really need to rethink why we use energy and the inherent needs of it, because that will be the driver for, in this case, crude oil, which is what we're talking about.
Yeah. So, well, just to build on that, so you said assuming just 1% growth, and I've been looking at the statistical reviews. I nerd out on it. I mean, I really do. I love this.
It's a great publication. I love it.
Oh yeah. But so assuming even 1% growth, but we had 3% in 2022. But assume 1%, and you combine that with the natural decline rate of 6 or 7 or 8%. So let's call it 7%. Add that 1%. So you're talking about an 8% delta between what you need to produce and just to keep up with demand, right? So that should assume that CapEx, that is capital expenditures, drilling new wells, all the other things you have to do to deliver the hydrocarbon molecule, those should be increasing at a commensurate rate. Or I mean, am I understanding this correctly?
Well, so these capital cycles are long. And so this capital cycles tend to be 10 to 15 years in nature. So from 2002 to 2014, we had a major boom in oil markets. We had major growth in CapEx, it triple, quadruple, whatever it was. And people are trying to do deep water and Arctic. And in those days, people thought Russia and oil sands and all these. And what it turned out to be was oil shale in the US, which even in the 2000s, no one was really going after it. Then suddenly shale gas was, became commercialized, and people said, well, if we can do shale gas, let's do shale oil. So that really didn't start till the 2010s. It was, and we'd spent a whole bunch of money trying to find a bunch of other stuff, which we didn't do. Now, we've been living off that bounty for the last now 15 years, 12, 13, almost 15 years, where we invested a lot in shale. We're continuing to grow production. But we've seen two of the biggest plays, the Bakken and the Eagle Ford, one in North Dakota, one in Texas, show signs of maturing where that production is flat or slightly down. The Permian Basin, which you referenced, Scott Sheffield of Pioneer, they've been a leader in that play. That is still growing. And what we haven't seen yet, or what will be the issue, is when that play matures, when we're not able to continue to grow the Permian, suddenly it's not going to be a question of growing CapEx 1 or 2 or 8% even to meet the demand. It will be a doubling, a tripling of CapEx. But we're not trying that yet. No one explores for oil anymore. We're not, signing new production sharing contracts in new countries. We're not doing any of the leading. And remember, it took 10 years to get shale going after a major boom. And there was no climate ideology back then. There was not a net zero objective. There was all the normal questions about
no ESG,
none of that kind of stuff. And it still took a decade to figure out, hey, shale's what works, not deep water oil. And we had some production from those other areas. And so, we are, I think, set up for a pretty big pinch point. I will still use the phrasing, though, of super vol rather than super cycle for the very reason, if you do not have inventories, if you do not have OPEC spare capacity, and you do not have sufficient supply growth, you do not get to have demand growth. And it means you'll have regular price spikes. But the flip side of price spikes is corrections and economic slowdown. And I think we've just gone through one of those periods. We went to 120 last May or June. We've had now 4 quarters of declining oil prices. Now, maybe the economy is going to hang in there or not. But this type of very volatile environment, I would say that is the kind of environment I would expect in a world where companies are not allowed to spend money, either because investors say you wasted money or because climate and ESG reasons say we don't believe you should spend money. Whatever the reasons are, it's going to lead to these continuous pinch points, I think, on the global economy.
And so when you say super vol, that's short for volatile or volatility. Then
correct.
That's it. So, right. Well, you have to have a name, right? You have to name it, right?
You do. I've still got an analyst at heart, right? So you got to brand these things a little bit. But I don't like the super cycle language because I think it implies a smoothness to the upcycle that I don't think will be there. When you're allowed to invest a lot of CapEx because either investors let you or there's not these climate concerns, well, then you have a chance for some supply growth to come on. We had a booming Chinese economy then. They joined the WTO, all the jobs that went over there and so forth, but it came with a lot of economic growth. We don't have those conditions. We're kind of at peak China in terms of industrialization and population growth, and we've not yet replaced it with the future of India or the future of Africa. And I think those countries and economies will develop very differently than China. But for all those reasons, it's not that sort of, hey, price can go up and demand still goes up like we had in the 2000s. I sincerely believe in this super vol environment.
Well, that's it. I like that idea or that phrase, the peak China. I've had Peter Zion has been on the podcast as well. And
I'm a big fan of his work. He's great. Yeah.
Yeah, I mean, a remarkable intellect. I mean, yeah. I don't know if you've seen his book. I think he dictated the whole thing. And I asked him, did you just dictate the whole thing? Because it reads like he just dictated
his 2014 book called The Latest That Russia Would Try and Go After Ukraine is 2022. I mean, he basically had it nailed to the year 7 years earlier. It was remarkable. So,
but he talks about demographics in China. And I think that's a really interesting story. I recently wrote on my Substack about Vietnam, right? That's the growth story in Vietnam. A lot of companies moving from China to Vietnam. So peak China, what do you mean when you say peak China?
It looks like they've had peak population, so
right.
It's a little bit of the Peter Zion perspective, which is, demographics are destiny. And that's not 100% true. But in this case, China looks like it's going to have a declining population. And so it means a lot of different things. The sort of mass industrialization they've done, which used a lot of energy and it used a lot of oil. The oil intensity of being an exporter of steel, cement, and all those kind of things is much more energy intensive than if you're a service economy. And so I don't think India will follow China's path. They'll have some steel plant growth and refinery growth, but it'll be much more of a consumer economy. It'll be much more of a service economy. And so I would not expect the types of energy intensity out of a place like India as just one example versus a country like China. But they've had sort of peak industrialization, never mind the world saying, hey, I think we became too dependent on this one country that maybe doesn't fully share our values and our perspectives. And there's some good to come out of China's growth. Generally, it's been a low inflation environment, but there's been some obvious geopolitical challenges that have been arisen. And there's been the gutting, as you well know, of our manufacturing base and our industrial base from the US to China. And I think some of those trends are starting to reverse. But China itself, the one-child policy, a clear example where, maybe not every government perspective is a good one. One child was their answer to their challenging economic situation from 30 years ago. They then just finally figured out that capitalism might be the better answer, but that's coming home to bite. And when you have a declining population, I think it's going to be a big, big challenge for China going forward. So
Well, and I'm just looking at the statistical review numbers, and the demand in China, oil demand went down 4% last year, and that's from a base of what 14 million a day. So that's 600,000 barrels a day. That's a big decline. And the U.S. Demand went up 350,000 barrels, something like that, almost 2%. But meanwhile, percentage basis, India goes up 8%, Vietnam's up 9%. Relatively small basis, Bangladesh up 19%. So speaks to that overall discussion about, what is happening in these developing countries where there is so much, what do you call that, latent demand or developing demand? How do you term that? What the people living in energy poverty going up the energy ladder? How do you describe that?
It's human progress, right? And we should all want it to happen and recognize that that is our number one objective as society, is to improve living standards for everyone in the world. I will say China's demand last year was down, most likely due to their extreme version of COVID lockdowns. And I think that is starting to reverse this year. So I think their demand will be back up again this year and will recover those COVID losses. But the strength of those other economies that you highlighted is absolutely those countries starting to come up that economic S-curve, if you will, and reducing the poverty, which is has to be our number one objective.
Right. And Africa overall, oil demand up 5%. And here's a country, a continent 1.4 billion. I mean, the potential demand growth there is just staggeringly large. But I just want to review. So you're a Tesla driver, but you're an oil analyst.
I am. Well, so this is part of it. I don't believe.
Aren't you supposed to be driving an F-250 or something, like some big monster V8 machine?
I don't like that energy has become ideological. I don't believe that, oil and gas should be Republican and solar and wind should be Democrat. It's frankly, honestly ridiculous. I think there's reasons to use all this stuff. As an example, if you're China and you currently import 12 million barrels a day of oil, my argument is they'd rather have coal-fired EVs than OPEC and Russia-fired ICE vehicles, as one example. And that's, to me, I think oftentimes Tesla and EVs are accused of being green vehicles. I don't drive it because it's green. I drive it because I like one-pedal driving. I don't like going to a gas station. And I live in a state, New Jersey, where we still have people filling up the gas for you. I was visiting my parents in Massachusetts. You have to fill up the gas yourself. Who likes to do this? It's disgusting, right? So charging at home, infinitely better. Now, I drive a total of 1.5 to 3 miles a day. So for me, having an electric vehicle is not a problem. Now, Tesla gets a lot longer range than that. But, the idea that EVs are the be all to end all and should be 100% of our mix, that to me is equally absurd. So let's take out the ideology of this. There's some people like myself who like the technology of the EV, who like the one pedal driving, who prefer charging at home. And there are other people who'd rather drive the big pickup truck. Now, I think the Ford Lightning has been very popular, but I'm sure there are people who drive hundreds of miles a day where it's not practical to do that. And so whatever one's view that is, the idea that poor people in Bangladesh or Vietnam or India are going to be driving Teslas or whatever their EV equivalents are that they can afford is simply preposterous on any sort of reasonable time frame. And so I do think I'm going to call it all of the above, but I also don't think the answer is fossil fuels only. I think there's plenty of reasons to use distributed solar in some cases. I think nuclear needs to be part of our solution here. I think there is inefficiency and waste that can be improved upon. So I would like to see the energy conversation move from I'm a Republican, so therefore I have to like oil and gas and hate solar, or vice versa. I would like to get out of that sort of polarization that we see. It's absurd.
Sure. Well, total agreement on that. I don't identify with either party, but yes, the ideological boundary setting between the parties on hydrocarbons versus wind and solar is deeply unfortunate. But I mean, it's also, I look at it, follow the money. I had one guest on the podcast talk about nuclear, and he said the problem with nuclear is there's not enough grift. That was his line, right? Whereas wind and solar, you got these tax credits. There is a lot of money that splashes around there, which is not the case with nuclear. But I digress. Is it so? Let's back to the oil thing. So you spent a lot of time studying this, and is it true that the more oil we find, the more oil we find?
The world is not on track to run out of oil anytime soon, right? And so we probably will stop using it as a world before we've run out of it. On the other hand, there's still lots of opportunity all over the world. So no one was expecting shale oil to be the big thing that actually resulted in it's been 70% of global worldwide supply growth over the last 10 to 15 years. That should scare the heck out of people in a world where we've become very dependent. And unfortunately, it's a good region to be dependent on. Thank God for the state of Texas. I don't live in Texas, but they've allowed and they have sets of rules and regulations that allow that oil to get developed. And same thing with North Dakota. But the world has become very dependent on, frankly, 2 U.S. states. And really one, it's mostly just the Permian Basin at this point in time. And sorry, some of that's in New Mexico as well. We do need to start finding oil in other parts. We need to bring back Canada's oil sands. I think what we should worry about most as a nation, and I speak as an American, we're recording this just before the 4th of July, is this idea that somehow ESG and climate folks are trying to limit investment in US and Canadian companies. So if you take it from the environmentalist perspective, let's just say they hate oil and gas for whatever reason, that's fine. Shouldn't you stop or try and limit supply from countries like those in the Middle East, Iran as an example, Russia an example, and allow the US and Canada to be those last barrels produced? Now, I think last barrel is going to be 100 years from now, but even if it's sooner, as some people project, this idea that you'd want to disadvantage US and Canadian companies is probably the part I most push back on in terms of that ESG and climate movement.
Fair enough. But well, I'll ask it again. And you gave him a long answer, but we have used a lot of oil over the last century, since 1859. We're using a lot of oil now, and yet the reserves keep growing. So is it that the technology, it seems to me in the big picture, you back up and you think, well, this is what are we seeing? It's the race between technology and depletion. And so far, technology seems to keep winning. So is it true it's true the more oil we find, the more oil we find?
Yeah, I mean, the shorter answer is yes, technology is winning, and it's on track to continue to win. We're using a fraction of the world's oil, original oil in place would be the phrasing. There's still plentiful oil here in the United States, in the Gulf of Mexico, in Alaska, in Canada's oil sands. I mean, the Middle East, and you think of so many countries are dominated by state-owned companies, where you don't have, as we do here in the US, hundreds, if not thousands of companies. Like shale was developed by independent producers, not by the big oil. In most of the countries, they have one company or maybe a couple companies, and they're very impacted by their government. You're not really even trying. Venezuela, as an example, they've obviously got challenges from a governmental perspective, but they've got some phenomenal heavy oil in Canada that just cold flows, meaning you don't have to heat it up like you do in the oil sands.
Venezuela, you said.
Venezuela.
Yeah, right.
Brazil's got a lot of oil. Like there is still a lot of oil to go after in all parts of the world, that I don't think the issue for why we should move off oil should be because of a lack of supply. That is not a reason to move off of oil.
Well, so let's build on that, if you don't mind, because that's one of the things that, to me, as I've studied the industry for a while and written about it, that hasn't that always been the problem, though, in the industry, is too much oil, not too little. I mean, that was the birth of the Railroad Commission, right? In the 1930s, after the Connolly Hot Oil Act empowers the Texas Railroad Commission to limit supply. And for the next 40 years, the Railroad Commission effectively determined price and therefore supply and therefore price. 1973 comes around, and OPEC, what did they do? Exactly copy the Railroad Commission model of limiting supply. So the question, has the world oil market has the problem of too much supply been the problem, or too little supply?
The world has never been short oil, even if at times it is thought that it was run out of oil. So it's called peak supply argument. Oh, oil supply is going to peak in some year and then it's going to head decline. That's often been used to make kind of a permanently bullish argument on oil, that, hey, there's no other way to drive your car. It's just the demand's only going to go up, but somehow supply is going to be limited. And that part has never come true. So when we talk about problems, I'll say this industry over 100 years, and my data goes back 50 years. There's another Substack, the Crude Chronicles, which has taken industry profitability back to 1910, the start of the industry, where you have some data. The industry's earned a cost of capital, as it should. So it's earned enough to allow supply and demand to be balanced. So in terms of, is it a problem to have too much supply? I'll say that's what's enabled this industry to grow. It's been the most certain growth you can have out there. So like iPhone stopped growing, I think, with iPhone 6. Most technologies get completely displaced within some period of time. This is an amazing industry. For 150 years, demand has grown. Now, it's only been 1 or 2% in recent years, but it has grown steadily since we started using it. And that demand growth has been met by supply growth. And there is no end in sight to that. We will go through temporary periods, like I think we'll go through this decade, where perhaps the Permian Basin and shale matures and we need to go find the next thing, or hope some countries like Venezuela or Brazil reopen up or what have you. But the world is not on track to run out of oil anytime soon. But is it a problem? No, it's what's allowed economic growth to happen, to allow people to come out of poverty. It's been a great thing. And industry has earned a cost of capital return, which makes sense. It's a commodity business. You compete away excess returns, positive or negative. It's done that over its entire history of 150 years.
Right. Well, so, but isn't that the bet then? Because the way you're talking, I'm assuming you're long oil, right? That you think that this is going to be, I don't know, you don't have to give me your personal portfolio outlook, but you're on the board of ConocoPhillips. So you believe that this need for oil is going to continue, but isn't it the race between technological advancement and the decline curve? And so far, the technology advancement has kept the price on an inflation adjusted basis really the same now for 50 years or more. So why would, if that's the case, if technology keeps crushing the what would be the potentially higher price, why go long?
It's a great question. Let me do my best to try and answer this, which is the two ways you make money in the energy sector. One is making that price bet that at least for the next year or 5 years or 10 years, supply is not going to keep pace with demand and oil prices are going up. That's one way to make money, but it's how people perceive that's the only way to make money. That's not true. The profitability of companies is not one-to-one with the oil price. There are periods of time it goes together, and there are periods of time it delinks for the industry and so forth. But there's also within that, your top quartile, your top two quartile companies, they've shown that they can earn, and they've done this historically, competitive returns on capital irrespective of the oil price. And I'll give you the example of Exxon and Shell going back to 1910. From 1910 to 2010, these were the largest, most dominant, more profitable companies in the beginning of the industry, 1910, and they remained as such by 2010. And that is not simply because they rode up and down the cycles. They invested at the low end of the cost curve. The cost curve sometimes is steeper, sometimes is shallower. When you invest in the low end of the cost curve, you have a chance to generate better than that cost of capital return sustainably. And my focus and my preference is on those sort of better in class companies that can generate through cycle profitability through the ups and downs. Now, some people say, I don't want to do that. I just want to make the bullish call. And when it's time to be bearish, I want to get out. That is a perfectly alternate way to invest in the oil sector. And for those folks, I will say, I think we're closer to the beginning of this cycle than to the end of this cycle. But a final point, when you look at the last super cycle from 2002 to 2014, profits only went up for the first half of it. And then companies started over-investing. So that even though the oil price continued to go up and stayed high, profits started going down. So these profitability cycles, which I spend a lot of time on, they are not one-to-one with the oil price cycle. I can never convince people of that. People always think if you like oil, it's because there's not enough supply relative to demand. Again, that can be a way to make money. It's not the only way. And frankly, it's not the preferred way. You'd rather invest, in my opinion, maybe this is a personal judgment, in these best-in-class companies that can generate double-digit mid-teens returns through the cycle.
And so, okay, well, then give me some names. And who do you like?
I don't do individual stock recommendations. What I will say is that historically, it has been the domain of the super majors that have generated those better profitability. So it's been the likes of Chevron and Exxon, and before they merged, Mobil and these types of companies. There's only a handful of them. And in Europe, some of those companies are trying to be energy transition leaders, and maybe they're backing away from that, maybe they're not. But I think people have called into question the European focus of trying to do different things that you don't know anything about. I think Exxon and Chevron, at least as best as we can tell, are more sticking to their knitting. So I'd say they've certainly got a decent chance to be amongst the profitability leaders. I can't comment on ConocoPhillips, but obviously I would expect any company I'm involved with to hopefully do its best. And then I think the question is who amongst the rest, the independent producers and the refiners. There will be companies who I think will be able to continue to invest at the lower end of the cost curve. And those would be the types of names that I think have a fighting chance. But it'll also change. Right now, it's been the Permian leaders. Maybe the Permian will mature and it'll be some different area. And I think that's what energy analysts try and spend their time looking at.
Right. Well, so about the Permian, isn't it remarkable that here is this province that's, I would argue, is the most drilled province in the world, that more oil and gas wells have probably been drilled within 50 miles of downtown Midland, Texas, than anywhere on the planet. And it's still the hottest play in the world. I mean, how remarkable is that?
It is absolutely amazing. And it actually gets to your earlier question, which is there have been many times throughout the last 100 plus years where the Permian looked like it was kind of done. And
Right.
in that play, it probably was done. So there have been a whole bunch of conventional or enhanced oil recovery plays that have sort of come and gone, and the shale will come and go. And I think we don't know what's next. I had last summer the opportunity to go to the Petroleum Museum in Midland, Texas, and they've got a great display that kind of goes through the end of the oil age predicted many times over the last 100 years. Every 20 years ago, people think it's the
Right.
end of the oil age. And we're going through that again right now. And it's always been disproven. It's been true. People have thought about that at the Permian as well, which is this is going to go away. And think about the rest of the world where we don't have hundreds and thousands of companies trying to prosecute what's next. There are entire countries that have had a fraction of the drilling we've had, who have not gone
Right.
through these technology revolutions. The Middle East is a great example. South America is another example where there is a lot of oil and a lot of oil opportunity. They may never get developed because of the governments in those countries, but that's very different than saying there isn't the opportunity in the first place.
Right. Yeah. So I want to read what you wrote about. This was on your Substack, and it's arjunmurti.substack.com. You wrote the key drivers, and I'm just reviewing some of the things that we've been discussing here, but I want to just read it so that people are listening will have your view here. You wrote, the key drivers of our view that oil demand is unlikely to peak this decade are: one, massive overestimation by most major forecasters of improved fuel economy gains, which have historically disappointed government-driven headline mandates by 70 to 95%. He said, excluding Europe and Japan, which have done better. Second, challenges with raw materials, infrastructure, and affordability of EVs. We expect considerable growth in EV sales, just not the hockey stick to near 100% global uptake within the 2030s. And then finally, number three, massive unmet energy needs of the other 7 billion, which we discussed earlier, that do not live in Western Europe, the US, Canada, or Japan. That's kind of, if I was going to boil down, I mean, you've written it, and I think you've written that several different ways on your Substack. No, not a criticism, but just that's your theme, that we're not done with this commodity. But can we talk about the molecule itself? Because that's one of the other things that I think people don't understand is that my line is, if oil didn't exist, we'd have to invent it, right? That it's just a near miraculous substance. Yeah. Have you thought about that? Or, I mean, we talked about the policy, we talked about the implications, but the thingness of the gasoline, the thingness of the diesel fuel, it's just incredible. And yet people poo-poo it and, we won't need that anymore. I mean, and then they fly on a 737 and don't think about what an incredible machine it is because of the fuel that goes into the wind tanks.
It's a great line, by the way. We're very fortunate it was invented, or we would not have had the type of population growth and economic growth and poverty reduction. I mean, the real explosion in sort of the betterment of human life that we've had during this age of oil and this age of fossil fuels has been a great thing, which doesn't mean we don't have environmental challenges. Clean air, clean water are all things, by the way, we can meet better when a country is richer than when it's poor. We have cleaner air in the United States than we do in other parts of the world, and we use the most oil out of anybody, and it's not a close call. And perhaps there's an objective as well to decarbonize, and we can debate that a little bit over the timeframes. But yeah, gasoline's an absolute miracle. Diesel fuel's an absolute miracle, and I think people do take it for granted. It's hard to explain why they do. I think you articulated why I think oil demand will continue to grow. The biggest thing people get wrong is actually those fuel economy gains. They assume essentially a tripling or quadrupling of fuel economy gains that there's no evidence we're on track for. Essentially, cars do have higher fuel economy standards, but cars become bigger and heavier each year, which kind of offsets, however much better the most recent BMW X5 is versus one 20 years ago. And so it's those fuel economy gains that has most people causing oil demand to roll over this decade, and they're just not on track. It's not a close call. And I think the EV hockey stick forecast, some of the idea that the world will be 100% EV sales by middle of next decade, you can just go through the list of copper and all the different raw materials technologies, never mind availability or electric grid stability or any of these other reasons for why I think that's going to be a big challenge.
Well, let's follow on that, because that's one of the other parts of this that seems to be a major disconnect, right? Between, what I talk about is the physical world, right? There's the policy world, and it's easy to make policy, but delivering molecules and electrons and doing it reliably, that's really hard, right? So what about the mining? Daniel Yergin has written about this. I had Simon Michaud on the podcast. He talked about copper demand. Have you done calculations, or what? Well, I'll ask it this way. talk about the material intensity of EVs and compare them to ICE engines, and what does that portend? What is that material intensity? How do you describe that as a limiter in terms of the growth of EVs?
Well, if you really went to 100% EVs by 2035 or 2040 or in some years, you'd need something like a 5-fold increase in copper supply and demand to meet that. It's just one example. And I'm not a mining analyst, so this does rely on the reports of others like Dan Yergin, you mentioned, my colleagues, former colleagues, I should say, Goldman Sachs, and a whole bunch of different banks have done good work on this. And the thing to remember is these copper companies and these mining companies, they're facing the same pressures oil companies are facing, which is, hey, we're coming off a decade where profitability is poor. We all remember the past CapEx cycles where you built too many copper mines and the demand we thought was going to be good. And then, and you know what, maybe it was good, but you still overinvested, right? China did grow a lot, but even with that growth, you overinvested in copper supply and so forth. So they're under the same pressures. And of course, you're not allowed to drill in the United States or Canada. We want to make sure you only exploit and pollute other countries like in Africa and so forth. I mean, it's an insane mindset, but that still exists. But even with that, these companies, these copper companies, these mining companies, they face a lot of the same pressure oil and gas companies do. So the idea that we're on track for the type of copper supply growth, aluminum growth, all the different metals, we're far from it. And that was something would have to change along the lines where suddenly there was a major CapEx boom in these other areas that we've at least not started yet.
Yeah, well, I like your parallel there because it occurred to me before, but you put it in an interesting way that these miners are facing the same challenges as the oil and gas producers, right? It's somewhat a different process, right? Drilling versus pulling the ore out of the ground and then refining it, but the basic rock or geology in some ways is very similar in that we've high graded the best prospects first, right? We drilled the best oil wells because we drilled the best prospects, the same as in the mining. And Micho's point that the ore quality is declining. Well, you have less ore quality or lower ore quality. You have to mine more stuff. You have to move more stuff. And then that's more energy intensive. So is that a long-term, I'm ask again, $10,000, you had it. Would you put it into copper mining? Or is that, again, an issue of which companies are going to be the ones that are the most efficient? Because that's your point on the oil and gas sector, right? That, yeah, the price may be higher, but it doesn't mean every company is going to make better profits because they might not be as well run. They might not have their geology of what their prospects are isn't as good. How do you think about that hard rock mining in general, base metals, et cetera, when you think about the energy transition?
It's a great question. It generally follows many of the same parallels that the oil industry does, which is, yes, the best deposits or the best ore quality or so forth have been mined, but through new technology and through resource development, you can start increasingly going after harder and harder stuff to do. And I think you have the similar issues, but you do have far fewer companies. So we're in the oil and gas business. There are lots and lots of choices in who to invest. And you can get a real spectrum of companies. You have consolidated these metals and mining industries to fewer players, certainly relative to the oil and gas industry. And so the amount of pressure you have to put on companies to not invest is actually far fewer of them. So for people who are against development as a general concept, there's frankly far fewer of these companies you have to go after and say, don't invest here. Where again, I use the example of shale oil. It was not ExxonMobil, as much as I admire Exxon and Chevron. It was not those two companies that pioneered, no pun intended, shale development. It was companies like Pioneer or back in the XTO Energy or Aubrey McKinnon's Chesapeake Energy that pioneered and really developed shale. And so we don't have that same kind of effect in mining where there are smaller and different companies going after this stuff. But yes, you have the same issues where you're either trying to play the copper cycle, that's one way to do it, or you're trying to invest in these best-in-class companies that you think will do well through the ups and downs. There's just far less choice in the mining sector, which is a challenge to getting this stuff developed.
Well, so how do people even understand that then? Because as you say, there are the copper deposits, and the countries that have significant copper deposits are relatively few. A lot of those are state-owned or state-controlled, or the state plays a much bigger role than oil and gas does here in the U.S. So, is there any way to look at those companies any way to rationalize them? I'm thinking about this again, and from a retail investor, someone that's looking at this and saying, "Oh, well, if that's the way forward, I mean, how does you just look to the Goldman Sachs analysts for their recommendations? How do you even begin to think about that kind of, or is that just a fool's errand to think you can make a smart investment in those kind of companies?"
I mean, the challenge with especially something like copper is you're trading in oil where people say, well, Saudi Arabia is an important producer, or Iran or Russia is. But hey, between the US and Canada, we consume about a quarter of the world's oil demand, and we also supply about a quarter of the world's oil demand. It
Right.
about matches, and we're very fortunate. So we can say, well, if there's a disruption in Saudi or Russia that would cause gasoline prices spike, yes. In places like copper, it's Chile, it's a handful of countries, and if they decide to have a changing government and they decide they no longer want these mines to produce under whatever the old terms were, it's a much bigger challenge in these other countries. Now, could you go through a copper exploration cycle and decide that, hey, in the US, yes, maybe there is some copper mines still to develop, or other parts of the world? I'm sure, but we have not started that any more than we've
Right.
started it in oil. So you do have to go find this stuff, and people actually have to be excited about the idea that the cycles are long for copper as well. So you go through 10 to 15 years where you're oversupplied, and people say, oh, we got enough of it. Yeah, well, that's true if demand wasn't going to grow and if we weren't going to try and go to 100% EV sales. But if you want to do that, then you're going to need to have a copper exploration cycle, and you got to have a copper capex cycle. Investors say, I don't want these companies investing 5 to 7 years based on some government mandated EV sale assumption that I think is going to get revised down at some point. And it becomes a real catch-22. It's got all the same kind of positive and negative challenges that the oil and gas industry does. It's actually more concentrated. I'm not sure why that's a good thing. So,
Well, as you say that, I'll read it back to you. So you have the geological risk, right, with the mine itself.
yep.
You have the technology risk on being able to refine lower cost or the lower grade or what have you. But then you also have, well, and then of course capital risk because it's such a long cycle. But then you have political risk because you're in Peru or you're in Chile, and as you say, oh, there's a new government, and by the way, they don't like you, Yankee, go home. I mean, those are a lot of risks to contend with on what your point about the long development cycle. But let me leave that alone for a minute. Let's talk about light oil and crude oil, because let me see, what is that, 16 years ago? No, 15 years ago. I wrote a book on energy independence, the myth of energy independence, gusher of lies, the myth of energy independence and the real fuels of the future. No, whether that's different. What is the name of the book? Anyway, I wrote it a long time ago about the myth of energy independence. We've heard this line about, oh, we're suddenly independent in oil. Am I right to say, well, no, we're producing light sweet oil. We're exporting light sweet and importing heavy sour. Can you talk about the mismatch between U.S. refiners and the crude that we're producing?
It's funny. When I was talking just a few minutes ago about the U.S. having sort of 25% of demand and 25% of supply, I was trying to resist using the term we're energy independent, because I don't believe we are, for more or less the reasons you just articulated. We are balanced numerically, but that's very different than saying. So I would say we have a reduced dependence on the rest of the world by virtue of our shale boom. We definitely have less exposure than if you're, again, say China and you're importing 12 million barrels a day of oil. But there is this issue where, and this is why when I look at the balances, I prefer looking at US and Canada together, because Canada generally produces a heavier oil. We generally, at least in the shale world, produce a lighter oil. And of course, our refineries for a while used to, consume light oil. Then when our production matured and we were importing Venezuelan and Mexican barrels, we re-geared our refining system. This is the 90s now, to produce, to run more heavier oils. And of course, then shale oils develop. And so it's actually an amazing thing that our refineries have over time been as flexible as they are. That's a credit to our country. It's a credit to our refining companies. But yes, it is more complex than simply saying liquids production is X and our demand is Y and therefore they're in balance. You clearly have to do it actually much more detailed than simply even light, medium, or heavy crudes. It actually matters by product, how much gasoline, diesel, jet fuel, and so forth that you're producing. It is actually energy is an amazing thing. We all take it so for granted. And I know you know this from the power space. It's true in the oil space as well. It is not anywhere near as simple as people make it out to be, which is why I think people are so off base into energy. Well, just change the oil to EVs and, we'll just go mine some copper somewhere and we'll be fine. And the whole thing is ridiculous. It doesn't mean you shouldn't try and develop new technologies or care about environment or any of this stuff, but there is a simplicity which people make these energy transition statements, which are just totally not on track to come true. But now we're on the verge of blackouts, which is a subject I think you'll know more about. We could be on the shortage of ultimately having insufficient gasoline in some markets if the refining capacity didn't keep pace. There are real issues with kind of the ignorance that I think our country and most citizens have towards energy.
Well, I agree, but it's not as not as pleasing to the ear to say, well, we're energy balanced numerically, and to say
this is why I wouldn't be a good politician. I'm not, this. I can do I can get the like Wall Streety kind of headlines, but I'm not good with the sort of political type, sound bites for sure.
No, energy independence sounds a little more pleasing to the ear than our oil market is balanced numerically.
And we're less dependent on the rest of the world, but that's not as exciting as saying we're energy independent. So
right,
for sure.
But am I right in terms of we're exporting because of what you talked about, our refineries, and I think that the term of art is the Nelson Complexity Index, right? Where you have very sophisticated refineries that they've invested exorbitant amounts of money to be able to import heavy sour crude at a discount to West Texas Intermediate, right? And refine that into diesel, gasoline, et cetera. But is it true that we're exporting is it the bulk, or do you know these numbers? The majority of our light sweet we're exporting, and then we're importing heavy sour. Do you know what the percentage there is?
Yeah, I don't have that to tip my fingertips, but you're absolutely right that it is a net export number that, again, the 23 and the 23, that's US and Canada technically balance out, but there's a whole bunch of exports and a whole bunch of imports in its place. And yes, it's generally we are exporting light crude oil and we're importing medium and heavy sour crude oils from the rest of the world to which is how we're refined, which is why where politicians can do real damage is suddenly decide they want to ban some amount of exports. Maybe it's gasoline exports they want to ban. And I think you really have to, that is where I worry, that you have spikes in gasoline. And it's too much to ask for good energy policy, but let's at least not have detrimental energy policy. That would be really bad stuff, right? Which would be some of these protectionist, let's ban exports of this and that type of thing that you often hear floated out there,
Yeah. What's your take on the Inflation Reduction Act?
Well, I think there are huge questions on whether giving a whole bunch of money to venture capital and PE firms and their CEOs is going to result in a scale up of new technologies. So I'll say it's probably better than an equivalent tax regime. I mean, I think we are about carrots, not sticks as a country, as a general commentary. I think for sure there'll be some very successful companies that are able to utilize these tax credits and corporate giveaways to make a whole bunch of money. I think it's a whole other thing to say, and we don't know whether those new technologies will scale up X the subsidy. And that I think we definitely do not know. And hydrogen is a great example. And I worry about this less for the United States than I do for Europe. Europe is presuming that hydrogen will be there at scale to displace a whole bunch of natural gas consumption, which I think is highly untested and uncertain. I think this is going to be true for a lot of these IRA type objectives. So I actually would say that it has been exciting to see a whole lot of new capital formation and companies formed, and they are for sure benefiting from the subsidies given out. And I think you can make a lot of money in this space as a PE or venture capital person or as the executives of these companies, whether it's going to be good for society or not, or more specifically, whether it's going to result in the ramp up of scalable new technologies that would work kind of X the subsidy, or at least without most of the subsidy. That is a huge question that we will not know for at least a decade, if not 2 decades. It'll make some people rich, right? So great.
Well, okay. Well, I won't necessarily agree with that last part, but let's talk about to me, it seems like this overall subsidy regime. Well, you get X if you just build solar and wind, and there's no sensibility about whether that area that you're building that solar and wind, whether they even need it, because it's like, well, you get a tax credit no matter where you build it. From a grid standpoint, that's not a good policy. Right.
But, yeah.
We need a more strategic approach. Well, we don't need more solar in wherever this one region is. Why are we building solar there? Because we got a tax credit. So it seems to me a very blunt instrument in terms of approaching what is a very sophisticated, complex network of networks, which is the electric grid. To just say, oh, here's a bunch of money, just go build some stuff, regardless of where you put it. I mean, that's how I see it. But does that ring true to you?
No, I think you're absolutely right. I do think it's an area you're more of an expert in, but the idea that we're only going to have a singular objective, which is CO2 net zero by some year, and we're only going to, without taking a holistic view of reliability, of, as you just point out, are we making the transmission line infrastructure needs, the last mile infrastructure needs? Are we doing any of this other stuff? But really the reliability being a key thing. We know in the coming years with continued energy demand growth, we are going to face some challenges with grid reliability. And I hope that will wake up the broader population to kind of the ideology that has led us astray, which again is not saying we should have zero solar and wind. I'm not saying that either. I think in some places it probably does make sense, but you can't just add it to the grid ad infinitum without caring about, or at least addressing, transmission lines, reliability, and so forth. That has to be part of a total package. And again, I know you're better versed than I am on it. I think this is going to come home to roost sooner rather than later. Maybe that will wake people up that you do need firm dispatchable supply or some other solution to ensure we have our 24/7 grid availability, which I think there is some risk we won't.
Right. So hydrogen, I think the H stands for hype. So that's my take.
We agree on that. Yes.
Okay. So
we'll see. I mean, we'll see. But it's.
So give me your read on hydrogen.
I mean, I have no issues with people studying it. My issue with hydrogen is the presumption that it will be there at scale, sort of X subsidy in some reasonable time frame. And again, I think it's a much bigger risk for Europe. So they, of course, became way too dependent on Russian gas. The Russian gas went away. They've disincentivized domestic gas production for whatever reason. They are trying to varying degrees importing LNG, but even there, they don't really want to. They don't want to sign the long-term contracts. They keep saying, well, no, it's still, they call it fossil gas, right? The most obnoxious term in the world. It's been called natural gas forever. But of course, they're climate ideologues. They got to call it fossil gas now, fine. But so if they don't want fossil gas by some year, the presumption that hydrogen will be there at scale, and let's just say you can force through subsidies that it will be there. Let's just say you have unlimited government resources somehow. I think the idea that your industry is going to be cost competitive at those types of electricity prices in the event it does not scale. Again, it might, but I don't understand how we can treat it with such certainty that it will. And that I think is where I'm not sure how, as a citizen, you'd want to be dependent on governments that have that sort of certainty in their planning for what is still an unproven technology from, again, the ability to scale at cost. You have to scale at cost. It's easy to say these words quickly. Scale at cost. Like, those are hard things to do. You can't just say it quickly. You actually do have to do these things. And to say that society is going to be dependent on this stuff, that's a huge, huge problem. It's a huge problem. How is Europe not signing long-term LNG contracts? It's insane.
Well, okay, so let's continue on the Europe insanity for just a minute. We'll just talk more broadly and not specifically Germany, of course, leading the insanity. But you made a key point, and my brother, Wally, who I'm very proud, he's done well in the insurance business, works for Arthur J. Gallagher. He says, nothing happens in industry and society without insurance. But you made the point recently in your Substack, arjunmurti.substack.com, that European insurers are saying they're not going to issue insurance for hydrocarbon projects of any kind. Well, that potentially has global ramifications because the European insurers are such big players. Can you talk about that scenario? If you add that on top of the ESG decline curves, 1% growth we've already talked about, I mean, is this where another reason for your outlook on super vol, to use your term, then that would be the other wild card in the mix here?
That's exactly right. And a lot of attention is placed on ESG, and we can certainly talk about it. I actually think to some degree it gets too much attention and is too much of a hotbed an issue. And I actually think the impacts of ESG on investment in traditional oil and gas is actually often overstated, that it's had a more modest negative impact than a major negative impact. The bigger risk is the Glasgow Financial Alliance for Net Zero, which is what you're referring to, which is, I'm just going to call that the umbrella organization for the Net Zero Insurers Alliance and the Net Zero Banking Alliance. And what they try to do is they say, as a bank or an insurance company, you should have an emissions finance target that should be, quote, Paris aligned, which means it should be net zero by some year, and it should be declining every year, especially starting now through 2030. And therefore, by, again, 2030, 2040, your financed emissions should go down by some prescribed amount. And the issue with that is, what if the new technologies aren't ready? What if we continue to need the old stuff? And of course, when we talk about these insurance alliances, who are we talking about? Are we talking about Russian insurance companies? Are we talking about Iranian insurance capital markets providers? No, we're talking about US and European firms. And who do they insure? And who do they bank? US and European companies. So we're basically trying to cut off the knees of companies that provide capital markets and insurance access to American and European companies, and to a lesser degree, Canadian companies. How does that make sense in any world that we live in? And the presumption, again, that these newer technologies are going to scale at cost. Keywords, you can just say them quickly. That there's such certainty to it, I find completely insane. And so there has been the Net Zero Insurers Alliance, under pressure from Republican attorney generals for antitrust concerns, has actually disbanded since I wrote that last article, which is a step in the right direction, but the pressures are still there. And a lot of them are still saying we're not going to finance new oil and gas projects. Again, what does that mean? They're not financing new Russian oil and gas projects or Iranian oil and gas projects or any other country. They're talking about US and European oil and gas projects. It is not a good thing.
And so to be specific then, because these European insurers play such a big role in the global market. So you're talking about Swiss Re, Munich Re, Lloyd's, right? These are going to be the big players that are not, or either primary insurers or, the line slips, right? They're providing these lines of insurance globally to other insurers, to other who are then reselling that coverage, right? So the potential impacts of this on particularly upstream, I would assume, would be the key here. That those are the things that could be another source. I said it before, but another source of volatility. If they say, "Oh well, you can't insure it, and you can't expand into whatever field," then that stops that production domestically, which then makes it, to your point, makes the U.S. more reliant on foreign hydrocarbons. Then have I restated what you just said?
You've nailed it. The only thing I'd caveat in what you said is I believe Lloyd's has actually been one of the few brave firms to continue to provide insurance. So I think they deserve to be favorably singled out. But some of the other ones you mentioned, Munich Re, Swiss Re, et cetera, ING, HSBC, I'm going to forget some of the names. Yes, it's a huge issue. And it's an issue in capital markets and in insurance markets. I think capital markets will be okay because there are more capital markets providers, and that is where the JP Morgans and the Goldman Sachs and the Morgan Stanleys of the world, I mean, they've resisted the worst of these pressures. It is really the European insurance companies is the kind of the group that I probably worry most about. Now, the oil and gas industry does have some self-insurance mechanisms, and they need to figure out why they still are a strong industry, probably how to boost and to enhance their own self-insurance out there as one of the avenues so that they are not dependent on these European firms in particular. Europe is really where I think the biggest issues are on this entire discussion.
Well, that's interesting that you say that, because that I know, and as I said, I'm proud of my brother and what he's done, but he's creating this self-insurance pools, and because what I've heard from other people in the oil and gas industry is they're decided, well, we're going to raise our own capital. Commercial banks are shutting us out. Well, we'll raise our own capital. We'll do it ourselves and make that happen as an alternative. So, Arjun, we've been talking for about an hour. I don't want to keep you too much longer. I'll ask you this question again. So, because you're a former Goldman guy, and Goldman Sachs obviously has a long reputation. So, not asking you for specific names, but we've talked a lot about hydrocarbons, but we're looking at also a world in which there's a lot of volatility, a lot of uncertainty, right? As much uncertainty in my adult life as I can remember. So if I said, here's $10,000, Arjun, go put it where you think I can make the best return on it. Would you put it in gold, in crypto? Tell me how would you allocate $10,000 right now?
So I'll speak for myself and how I kind of think about my own personal investments, which is I am not a day trader or a short-term person. So that's just not how I think about things. That I'm fortunate that I've had a good career where I've been able to invest for the long term. If we were in 2030 and I look back over the previous decade, will I have been happy to have owned oil and gas companies? I think the answer is yes. So they're broad-based indices like the XLE, they're individual companies that people can do work on, but I will be focused on, okay, I think this sector is going to pay out a bunch of dividends. There's going to be a lot of volatility along the way, but through all that volatility, you're going to have mid-teens or better returns on capital. And that would compare favorably with the broader market. So right now, energy is about 4% of the S&P 500, the major index. Its earnings are about 8%. That kind of got to the PE point you made at the beginning of the discussion. Now, will they get back to 8 or 9 or 10%? I think they will. So do I think the sector will outperform the broader market looking out over this decade? Yes, I do think it will. It's going to be very volatile along the way, but I really do like a lot of the traditional energy names, and in part because there's assumption that it's going away. And I'm going to argue not only is it not going away, I think it's actually going to continue to grow, and it's actually going to grow with, from a sector average perspective, better profitabilities after a 15-year down cycle. It'll be a 15-year up cycle. But then for the best-in-class companies, they may be able to even sustain that through all the ups and downs that we expect. And so I do like the traditional oil and gas sector. I think Canada within North America is an interesting place. We are going to need Canada's oil sands to be part of the energy transition solution. It's going to be needed supply in the world. They've been as out of favor as any U.S. company has been. They're a little bit more like the mining stocks we were talking about before, where it's long lead time production. If you're concerned oil demand is going to go away, you're not going to want to invest in some Canadian oil sands mine. But Canada within kind of the global sphere is an area that I like a lot as well. Canadian oil and gas. Yeah.
So your short answer on the $10,000 is buy oil and gas in the U.S., equities in the U.S. and Canada. Am I reading that back correctly?
That is where I've personally invested. That is correct. So
you're not a gold guy. You don't believe in any other asset. That's your favorite asset class, is what I'm hearing you say.
I think we have lots of currency issues that are definitely for another speaker and a different podcast. And gold probably plays some role in that, but I'm for sure not a gold expert. So I think on the copper and the mining stuff, it's also got a role. Again, it's not quite my area of expertise. The only thing I worry about with copper and some of those commodities are a lot of the call is based on we're going to have a rapid energy transition, which I don't think we're going to have. So if you start taking down your EV forecast and you start building more sanity into the projections, it does take away some of that upward pressure from demand. And if I also have the view that we're kind of past peak China and it past peak industrialization in China, then some of the heavy industry that also drove the demand of those other commodities I worry about, where I feel like people feel most confident that oil demand is going to go away. And I'd say it's like the last thing to go away, that we are most likely to have oil demand continuing to grow for the foreseeable future. Even natural gas, like you could do coal or you could do nuclear or you could do solar and wind or anything that you might like, or just like some of these things. But there's lots of ways to do power generation. There is a miracle to gasoline and diesel, and you alluded to it, that I share. And I think there's a certainty, therefore, to oil demand growth, assuming we are still optimistic that the world wants to get lifted out of poverty, which I think it does.
Right. Well, one more question since we're on that, and then I'll have the final two questions. So I noticed in your Substack, you talk about ROCE, return on capital employed, a lot. Is that your favorite? Well, it appears to be one of your favorite metrics. Am I reading you correctly? And if so, why is that such an important metric compared to, again, I'm an observer. All of my money is in Schwab dividend, right? I have an ETF and I know how that works. It's low cost blue chip stocks that pay dividend. I can understand, right? I'm not sophisticated enough to do these deep dives, but you do, you feature ROCE a lot. Why is it, and why is that such an important metric for you?
And it is one of my favorite metrics. What I'd say is people can use different metrics. The point would simply be the goal of a company is to generate profits for its shareholders. And in doing so, we will meet societal goals and so forth. So I'm a profits first. That is the purpose for why companies exist, to meet profits. You can't have your plants blowing up. You can't violate government laws. There's a whole bunch of rules and regulations and environmental standards you do have to live by to generate good profits, but it is profits first. And I think in the oil industry, oftentimes companies will focus on barrels and let's produce more. And hey, I think this is low cost, and maybe it is low cost, but maybe some of the costs are higher cost. Everything ultimately has to reconcile to full cycle profitability. So you mentioned this Schwab blue chip dividend fund that you prefer. I will, without knowing anything about that fund, for those companies to be able to pay dividends, they're going to be profitable companies. From profitability comes dividends. And so it is a way to me, this is the purpose of companies. It is to generate profits. I am a proud believer in capitalism. It doesn't mean we don't need rules and regulations. We do. I may like limited government, but I'm not for anarchy. You do need some amount of rules and regulation out there for sure, but the goal of a company is to generate profits. And I think in all industries, people often get wrapped up in, I produce barrels, I produce this widget or this technology or what have you. You have to make money. It makes your company better. It makes your employees better. It makes society better.
Well, that's good. Yeah, I like the way you put that. My response would be, well, if it's not profitable, it's not sustainable. Because I hate the word sustainability. It's overused.
You're better with the buzzwords than me. That is a much better line. If it's not profitable, it's not sustainable. I like that a lot. You may see that show up on my Substack if I may borrow it. So.
No, don't borrow it. Steal it. It's yours. Okay. My compliments.
Thank you.
Last two questions, Arjun. What are you reading? What's on the top of your? I see books behind you there. One on Led Zeppelin. It looks like some others. What are you reading these days?
So I'm reading two books right now. One is called The Big Rich, which is the rise and fall of the great Texas oil fortunes. It's written by Brian Burrow. I think it actually came out like a decade ago. It was a gift I received on that trip to the Permian Basin last year. Really enjoyed it.
It's probably 20 years old now. I have that book, Brian Burrow. Yeah, that's an old. Yeah, sure, I know that book.
Then I'm also reading Coal in India. Coal is one of those topics where coal is now basically not used in any appreciable way in the OECD. It is now 90% a non-OECD fuel. And I don't see why China is going to stop using its coal, especially if it's past peak population and peak industrialization. Why would they build a new electric grid? It makes actually no sense. And when I think about China, India and Pakistan, why would they be paying world LNG prices when they have a domestic coal that is low cost, it's reliable, it's jobs, it's tax dollars, it's bureaucracy? But I think there is a general understanding that I don't have. I'm not a coal analyst by background. So it's a book called Coal in India. It's by Rahul Tangia. I may be mispronouncing his name, and two other individuals, all of seeming Indian heritage. I'm reading that as well. And I'm also reading Ayn Rand's The Fountainhead. So I've read Atlas Shrugged a couple of years ago. I actually never read The Fountainhead, and I'm about a quarter of the way through that. So I'm reading that one as well.
Yeah, well, we didn't touch on coal, but that's another topic that I think is really interesting. Vietnam is boosting its coal production. Pakistan in February said, we're out of the LNG market. We got priced out. We're going to quadruple our coal-fired capacity, which, this is a country that is desperately poor, as you know, and desperate, having ongoing blackouts and desperately needs a more reliable grid. Last question, then, Arjun. What gives you hope?
What gives me hope is things like Substack and seeing more voices come out there where I was happily sort of retired at Goldman and doing all this board and advisory work. But as this energy transition discussion just, to me, went completely off the rails, I did feel an obligation to look, hey, this is something, I know something about the oil and gas industry, and what I'm hearing is not accurately portrayed in the mainstream media or by politicians or what have you. And I felt an obligation to simply write about it. Doesn't mean I'm right. Any client will tell you I've made many wrong calls about many things, and I could well be wrong in these perspectives, but I know that the other people are wrong too, for sure. I know some of these perspectives on oil and gas are just simply, they're wrong. They're not accurate. And so I take hope in things like Substack and voices like yourselves. And again, I listen to people across the spectrum, both domestically and globally. There are many different views out there, and it does give me hope that there is an opportunity for people to get educated and to make better choices going forward. So I actually feel very hopeful that we're through the worst of the energy conversation. We may not be through the worst of the energy crisis, but we're through the worst of the energy conversation, and people can start recognizing some of the falsehoods that's been told to them about how easy it is to transition and how this technology or that technology can ramp up and it's the be-all and end-all when there's no way it is. There's no chance it is. And I take hope in that. I take hope that people in Africa are starting to speak up their own voices. How is it that Africa, with 1.4 billion people, 17, 18% of world population, only uses 4 million barrels a day, 4% of the world? So there's no justice in that. Where's the justice in Africa using just a fraction of the world's oil? They actually export more oil to the rest of the world than they use domestically. That is not okay. So the exploitation of that continent, which is comprised of 52 or 53 individual countries, that is something where I am happy to start hearing African voices rise to self-advocate for their needs and not rely on these frankly awful European-based institutions like the United Nations, like the IEA, like the Glasgow Financial Alliance for Net Zero. More African voices are a good thing. And to me, it is going to be the key to having a healthier energy evolution. The actual fate of Africa, that is where this energy evolution will lie.
I think that's a good place to stop. And I can say amen to that. And I agree with you on many of these issues. And I just recently wrote about that on Substack in a piece called Let Them Eat Solar Panels, which is about Exim Bank loaning $900 million to build a solar plant in Angola when they should be building a natural gas-fired power plant. Yeah. But that was my work. My guest has been Arjun Murti. He is a partner at Veriton.com. He also is a publisher of Super Spiked on Substack. You can find it at arjunmurti.substack.com. Arjun, this has been great fun. It's one of the joys of the podcast. I get to talk to people like you and to learn, and that's why I do this. So many thanks for coming on the Power Hungry podcast.
Robert, thank you so much for having me. Thank you for all you do, and it's been a real pleasure to speak with you today.
Thanks. And to all of you in podcast land, thanks for tuning into this episode of the Power Hungry podcast. Be sure and tune in next time. Until then, see ya.